What's up, everyone? It's Kay here back with another video, and today we're actually going to be discussing the Greek. So we're going to be talking about delta, gamma, vega, theta, and rho today. So let's go ahead and hop right into it. So first and foremost, the very first thing that we want to talk about is going to be delta. Now, delta impacts the premium and essentially the options value as well. So when it comes to delta, I like to consider it to be pro buyers and anti sellers. So in favor of the person who's actually taking on the risk or buying the contract, but not in favor of the person who is actually writing the contract or the individual who owns the underlying asset. So the 100 shares of the underlying asset. Now, delta is identified by how much the options premium will change if the stock's price moves up just $1. So right now the market is actually open, and as you see, Netflix is actually kind of fluctuating. It's roughly at the $403 mark, give or take. So after it moves up an additional dollar, if we just pay attention to this particular strike price right here, which is 405, then we're actually going to be adding in an additional $48, okay? Now, delta also gauges the probability of your contract expiring in the money. So as it stands right now, there's about a 48% chance that it's going to expire in the money. And the higher the delta, the higher the probability of it expiring in the money and vice versa. So delta actually increases as the option moves further into the money. So as it goes up to maybe 404, 405, 406, you'll start to see delta actually increase. And that has a lot to do with Vega, but we're going to get into that as well. And then it also decreases the further out of the money that it goes as well. So now that we've covered delta, let's go ahead and move right over to gamma. And I'm sorry, gamma affects delta. Okay, so now when it comes to gamma, gamma measures delta's rate of change. It works hand in hand with delta. And so basically, after the first dollar, or essentially on the second dollar, you're going to add your gamma into your delta. So on that second dollar, as it stands right here on the $405 strike price, you're basically going to add that $3 into your delta. And that's the way delta actually starts to move up as it increases in dollars, right? So now keep in mind that these two are kind of like cousins. They work hand in hand. So you kind of want to see good delta and good gamma. So those are very important. Now, the next one we're going to look at is going to be theta, or time decay, premium burn, premium decay, however you have heard it before, however you consider it, that's essentially what it is. Theta is pro seller, so it works to the benefit of the person who actually wrote the contract, but it is anti-buyer. So the minute that you buy your contract, your theta starts to kick in. Now, let's just use this as an example. Right now, it's about $1.49, $1.50, give or take. It's fluctuating because the market is open. So with that being the case, there is no way for you to say, hey, at 12 p.m. Eastern Standard Time, my contract is going to lose $1.40+. There's no exact time. It's a gradual thing. It happens in real time, but this is what you actually stand to lose per day as your contract is open. And theta, much like delta and gamma, it increases as time goes on. It also increases, I like to say, more towards the middle of something. So if you're in a weekly contract, it really kicks up in the middle, right? On a 0 day, it really kicks up at that half point of that particular day. Now, when it comes to the next one, which is going to be Vega, Vega is related to implied volatility, and it represents how much your premium will change with a 1% point change in implied volatility. So I'll actually show you that, and then I'll just bounce back over. So we're just going to look at implied volatility really quickly. So when there is a 1% change, so once this moves up 1%, then you're actually going to see your premium impacted by Vega. And then when it comes to implied volatility, it's essentially a way of saying suspense around a particular event, like earnings releases or elections or federal speaking engagements. Maybe Nike released a new shoe that everyone is going crazy over, or Apple is dropping some, new phone line, or, a new product, or what have you. So that's what implied volatility means. It's the suspense around that particular event. And then when the suspense is no longer there, when it maybe has been released, then you may see, a fluctuation, a big fluctuation when it comes to your implied volatility. So now let's just switch back over to the Greeks. And now there's one other one that we want to look at, right? And so the other one that we want to look at is essentially rho. So I'm actually going to customize really quickly and I'm going to add it. We don't really talk about rho too much, and I'll tell you why. Rho is one of those Greeks that is important whenever there is a, interest rate change. And because interest rates don't really change that often, we don't really look at it that much. It's not that impactful to your contract, but it does have an impact to your contract, if that makes sense. So hopefully this helps you to understand the Greeks. Now, when it comes to trading, especially day trading, we like to tell traders, in any case, if you're swing trading, day trading, or a long-term investor, you always want to have high delta and low theta, right? But as you can see right now, we're actually looking at Netflix. Now, Netflix is one of those tickers that has the ability to move over $10 in a day. So if we just multiply 10 by, delta, right? Right now it's at 48. So if we multiply $10 by 48, we're going to get $480, right? We haven't even considered the fact that we also add gamma into it, starting on that second dollar, right? So it's really more than $480. Now, because it can move so much, average true range wise, or ADR wise, average daily range wise, this is the reason why we can actually opt for this, especially if we're day trading, because we're not really holding that position too long anyways. We're in and out when we're day trading. But when you have something that can actually override or trump your theta decay, which is 100, and let's just say $150, 150 versus the potential to exceed over $480, given the amount that it can move on the average true range, that's a very big thing and something for you to always consider. There are instances where you have a ticker that can have a very high ATR that can override your theta decay. So hopefully this helps you all. If you like this video, please like, comment, and subscribe, and I will see you in the next one. Have a great day. Bye.